Hello and welcome to Kenanga Research. My name is Sarah Lim.
And I am Marie Vaz.
Today we will be highlighting the impact on Budget 2017 on the plastics and packaging sector. So Marie, what were the main highlights for the plastic and packaging sector?
Well, Sarah, there were no specific measures directed towards the plastic sector in Budget 2017, as it was mostly a non-event for the sector. This was probably due to the fact that in Budget 2016, the government announced a special reinvestment allowance to extend the tax incentive for capital expenditure from 2016 to 2018, allowing 60% of capex to offset 70 to 100% of statutory income.
Although there are no specific sector benefits, what are your views on the recent allocation to the Capital Market Research Institute of 75 million and special funds of up to 3 billion to licensed fund managers to invest in small mid-cap listed companies?
Well, I'm glad you asked, Sarah. We believe this allocation will help invigorate small mid-cap companies with less than 1 billion market cap, as there are still some under-researched yet growing sectors such as plastic packaging that would see a re-rating.
So the plastic sector has definitely fared very well over the last 2 years. Do you believe that the sector can grow further? And are there actually upsides to look forward to for investors?
Very much so. In fact, since August 2016, the FPM small cap has been sold down by 1.6%, with SLP and SCGM being part of the sell down as profit-taking activities were seen on well-performed stocks. But fundamentals for the sector are intact. The ringgit remains weak versus the USD, which should help sales as most plastic packages rely on export markets for sales. Secondly, raising costs remains low, and the sector is expected to see long-term earnings growth through expansion in product development as they move towards automation and innovation whilst venturing into higher margin products for clients, resulting in higher margins.
So what are your top recommendations for the sector?
We recently initiated coverage on SCGM with an outperform call and a target price of 381, which is one of our top picks. In fact, SCGM has 16% total returns with an attractive core margins of 14 to 15%, driven by high margin innovations, strong earnings growth, about 15 to 30% in 2017 and 2018, on upgrading and expansion, while the polystyrene ban will help new F&B container markets. Our other top pick is SLP, with an outperform call and target price of 311, commanding 32% total returns on strong earnings growth, driven by increased sales from tapping into new export markets and on higher margin from value add and niche services. Lastly, we have Scientech as our third top pick. We have an outperform call with a target price of 757. Although Scientech is not a small or mid-cap stock, we expect it to benefit alongside the sector on strong earnings growth potential and stable margins, commanding 15% total returns.
So that is all we have for today. My name is Sarah Lim.
And I'm Marie Vaz.
Thank you and have a good day.